Welcome back to the channel. Today, we're diving deep into the mind of one of the greatest investors of all time, Warren Buffett. You know, the Oracle of Omaha? We're talking about the common mistakes even seasoned investors make, and more importantly, how to avoid them. Over the years, Warren Buffett has dropped some serious wisdom bombs on investing. We're going to break down his top 10 investment mistakes so you can sidestep those potholes on your own journey to financial freedom. Stick around because this information is pure gold. Time in the market beats timing the market. Ever heard that one? It's one of the most fundamental principles of investing, and Warren Buffett lives by it. The earlier you start investing, the more time your money has to grow, thanks to the magic of compound interest. Think of it like a snowball rolling downhill. A small snowball at the top might not seem like much, but as it rolls down, it picks up more snow, getting bigger and bigger. Let's say you invest $1,000 a year starting at age 25. By the time you're 65, assuming an average return of 7%, you could be looking at over $1 million. If you put off investing until you're 35, even if you invest the same amount each year, you'd end up with significantly less at retirement. The beauty of compound interest is that it rewards consistency and patience. So don't wait. Start investing today and your future self will thank you. Raise your hand if you can predict the future. No one? Yeah, that's what I thought. Trying to time the market, buying at the absolute bottom and selling at the peak, is a fool's errand. Even Warren Buffett, with his decades of experience, will tell you straight up that it's impossible to consistently predict short-term market movements. The market is driven by a million factors: economic data, geopolitical events, investor sentiment. It's like trying to predict which way a leaf will blow in the wind. You might get lucky once or twice, but in the long run, it's a recipe for disaster. The truth is, trying to time the market often leads to buying high out of fear of missing out and selling low out of panic. Instead of trying to outsmart the market, focus on what you can control: your investment strategy. Invest consistently, diversify your portfolio, and tune out the noise. Remember, long-term growth is the name of the game, not trying to be a Wall Street psychic. One of Warren Buffett's most famous quotes is, "Never invest in a business you cannot understand." If you don't have a solid grasp of how a company makes money, its competitive landscape, and its future prospects, you're essentially throwing darts blindfolded. Think about it. Would you invest in a restaurant without understanding the menu, the location, or the competition? Probably not. The same goes for investing in the stock market. You need to do your homework. This doesn't mean you need an MBA to be a successful investor. It simply means sticking to industries and companies you understand. If you're a tech whiz, you might feel comfortable evaluating software companies. If you're a fashionista, maybe you have a knack for spotting trends in the retail industry. When you invest in what you know, you're more likely to make informed decisions based on logic, not hype. Don't be afraid to pass on investments that seem too complex or outside your realm of knowledge. Over-diversification or under-diversification. Finding the sweet spot. Diversification is like the balanced breakfast of investing. You need enough variety to ensure you're not putting all your eggs in one basket, but not so much that you can't even taste your food. Over-diversification, or owning too many stocks, can dilute your returns. On the flip side, under-diversification, or concentrating too heavily on a few stocks, can expose you to significant risk. The key is finding the sweet spot. A well-diversified portfolio should include a mix of asset classes, stocks, bonds, real estate, and within those classes, a variety of sectors and companies. The right level of diversification depends on your risk tolerance, time horizon, and investment goals. Letting emotions drive your decisions. Don't panic sell. Fear and greed. The two most powerful emotions in investing, and they can absolutely wreck your portfolio if you let them. When the market takes a nosedive, it's natural to feel panicked. You see your hard-earned money vanishing and your instinct is to sell everything before it's all gone. But here's the thing. Panic selling almost always leads to buying high and selling low, the exact opposite of what you want to do. Remember, the stock market is a roller coaster. There will be ups and downs, but over the long term, it's trended upwards. On the flip side, greed can be just as dangerous. When the market is booming, it's easy to get caught up in the hype and start chasing returns. The key to successful investing is to remove your emotions from the equation as much as possible. Develop a solid investment plan, understand your risk tolerance, and stick to your strategy, even when the market gets bumpy. Remember, investing is a marathon, not a sprint. Ignoring fees and expenses, those small numbers add up. Fees are like termites, they can eat away at your returns over time. A 2% annual fee might not seem like much, but over 30 years, it can eat away a significant chunk of your potential profits. A low-cost index fund with a 0.1% fee could save you thousands. Those small numbers can add up to a big difference in your long-term wealth. Following the crowd, don't be a sheep, be a shepherd. The stock market can sometimes feel like a giant game of Simon Says, with everyone chasing the latest hot stock or trend. But here's the thing. Following the crowd rarely leads to long-term success in investing. By the time everyone else is piling into an investment, it's often too late. The price is already inflated, and you're more likely to buy at the top, just before the inevitable crash. Warren Buffett has a great quote about this. Be fearful when others are greedy and greedy when others are fearful. In other words, don't be afraid to go against the grain. Do your own research, think independently, and don't be afraid to zig when everyone else is zagging. Investing is not a popularity contest. It's about making smart, informed decisions based on your own financial goals and risk tolerance. Don't let the fear of missing out or the allure of quick riches cloud your judgment. Not having a clear investment plan. Failing to plan is planning to fail. Imagine building a house without a blueprint. Sounds like a recipe for disaster, right? The same goes for investing. Without a clear plan, you're essentially wandering aimlessly. A solid investment plan outlines your financial goals, risk tolerance, and asset allocation. Start by defining your financial goals. Are you saving for retirement, a down payment on a house, your kids' college education? Once you know where you want to go, you can figure out how to get there. Neglecting cash reserves. Don't get caught with your pants down. Cash is king, or so the saying goes. Having a healthy cash reserve is crucial. Think of it like an emergency fund for your portfolio. It's there to cover unexpected expenses or seize opportunities. Imagine this. You're fully invested, feeling like a financial rock star. Then, bam, your car breaks down, your roof starts leaking, or you get laid off. Suddenly you need cash and you need it now. But because you're fully invested, you're forced to sell your investments at a loss. That's where cash reserves come in. Having a cushion of cash on hand gives you the flexibility to handle life's curveballs. It also allows you to take advantage of opportunities when they present themselves, like a stock market dip or a once-in-a-lifetime real estate deal. How much cash should you keep on hand? It depends on your individual circumstances. A good rule of thumb is to have 3 to 6 months worth of living expenses in a high-yield savings account. Not learning from mistakes, the definition of insanity. They say the definition of insanity is doing the same thing over and over and expecting different results. If you're not learning from your mistakes, you're doomed to repeat them. View mistakes as learning opportunities, not failures. Analyze what went wrong and how to avoid it. Keep a journal of your investment decisions. This will provide a valuable record for the future. Outro: avoid these mistakes and invest like Warren Buffett. There you have it, folks. Warren Buffett's top 10 investing mistakes to avoid. By understanding and avoiding these common pitfalls, you'll be well on your way to building a solid financial foundation and achieving your financial goals. If you found this video helpful, don't forget to smash that like button, subscribe to the channel, and hit the notification bell so you never miss an episode. See you in the next video.